Welcome. In this video, will the ZBCN coin attack come? We will analyze it. Don't forget to subscribe and like, and please watch the end to understand.
The Elliott wave theory is a highly powerful and effective analytical tool that allows us to interpret price movements in financial markets through wave structures. According to this theory, price movements in the markets develop within certain wave patterns, and each cycle typically consists of 5 main impulse waves followed by 3 corrective waves. As can be clearly seen in the chart we are currently analyzing, the price movement has most likely completed the second wave of the 5-wave impulse and now appears to be entering the 3rd wave phase. The occurrence of this transition points to an extremely positive technical structure. According to Elliott wave theory, the 3rd wave is usually the longest, strongest, and most voluminous of the 5 impulse waves. This wave represents the period when investors' confidence in the market increases, buyers enter strongly, and prices gain significant momentum. This new momentum formed after the completion of the 2nd wave generally signals that a new trend is deepening, and the upward movement will continue more decisively. Looking at the current chart structure, it is evident that the 2nd wave respected Fibonacci retracement levels, pulling back between 61.8% and 78.6%. This strongly suggests that the 2nd wave may have been completed in line with the classic Elliott structure, and we are now at the beginning of the 3rd wave. When it comes to the potential targets of the 3rd wave, Fibonacci extension levels come into play. In Elliott wave analysis, the 3rd wave is typically at least 1.618 times the length of the 1st wave. This reflects market participants' confidence in the start of a new trend and the strength of buying pressure. Therefore, the 3rd wave not only represents a price increase, but also has the potential to peak in terms of momentum and trading volume. It is typically the wave where major players and institutional investors begin to expand their positions. According to the current structure in the chart, the most conservative target for the 3rd wave would be a move equal to 1.618 times the length of the 1st wave. This target aligns well with technical analysis standards based on historical data and numerous market examples. However, in some cases, especially during times of high market enthusiasm, this extension ratio can increase further. This is where the 2.272 level comes into play. This level appears in cases where the 3rd wave extends much more strongly and investor psychology becomes increasingly positive. Another important factor to consider during the transition from the 2nd to the 3rd wave is that broken resistances now act as support. As the price begins its upward move from the low created by the 2nd wave, it often breaks through previous key resistance levels. The breaking of these resistances confirms the uptrend technically. These zones will also act as strong support areas during pullbacks in the 3rd wave, which is extremely important for the sustainability of the uptrend. To view the 3rd wave movement more clearly, time-based analysis is also often conducted on charts. These analyses provide insight into how long the 3rd wave might last. According to Elliott rules, the 3rd wave also tends to be longer than the 1st wave in terms of time. That means it not only travels further in price, but also lasts longer in duration. This provides investors with more opportunities to evaluate their positions and maximize profits. Considering the currently developing structure in the market, and assuming we are only at the beginning stage of the 3rd wave, it is highly likely that the uptrend will accelerate in the upcoming period and that larger price targets will come into focus. Especially as the price moves toward the 3rd wave's target zone between 1.618 and 2.272, the technical outlook will become increasingly positive with the break of intermediate resistance levels. At this stage, the most important thing investors should pay attention to is the fact that the price may naturally experience some corrections while progressing toward the 3rd wave targets. These corrections are necessary for the healthy progress of the technical structure and should be considered as brief resting periods that do not disrupt the main trend. During these short pullbacks, the price often returns to test previously broken resistances before continuing its move with stronger momentum. If the 3rd wave truly develops in line with theoretical expectations, a short corrective 4th wave will follow its completion. However, this is a subject for discussion at a later stage. What should be focused on right now is the strong upward response shown by the price after the 2nd wave, which clearly indicates the transition to the 3rd wave and suggests that this wave has the potential to expand to significantly higher levels. In conclusion, when viewed in the light of technical analysis, the price movement is progressing in a structure that closely aligns with the classic rules of Elliott wave theory. The completion of the 2nd wave and transition to the 3rd wave creates a significant window of opportunity for investors. Since the 3rd wave is typically the strongest, most distinct, and most profitable part of the trend, remaining in position or opening a new one at this stage would likely benefit investors. Of course, as always, risk management should not be overlooked. But in light of the technical data, it is highly probable that this third wave will extend between 1.618 and 2.272 times the length of the first wave. This scenario provides strong technical signals that prices may reach much higher levels in the near future. But we can't make decisions solely based on Elliott waves. Let's now look at other metrics as well. Stay tuned.
On the chart, the traces of the long-standing downtrend that had been weighing on investors' morale were clearly visible. For a certain period, the price exhibited a classic bear market structure by forming consecutive lower highs and lower lows. This situation led to a prevailing sense of pessimism in the market and created an environment that eroded investor confidence. However, upon close examination of recent price movements, it becomes evident that this negative structure is gradually breaking down, giving way to a more promising technical outlook. Especially in the past few weeks, the fact that the price has held above previous lows, formed higher lows, and begun to reach higher highs indicates a significant transformation in the market structure. Such a change is often interpreted in technical analysis as a trend reversal signal. This is because the price is no longer forming lower, but rather higher lows and higher highs. A higher low indicates that the asset is no longer finding buyers at lower levels, and that buying pressure is starting to increase. Similarly, higher highs show that the price can reach new peaks despite selling pressure, and that sellers are not as strong as they once were at previous levels. When these two core structures, higher lows and higher highs, come together, it suggests that the market structure has shifted from a downtrend to an uptrend. In addition to the shift in highs and lows, trend lines that support these structures are also of significant importance for investors. Currently, with this new ascending structure, the price has touched a trend line that has changed from a downward slope to an upward slope. This trend line acts as a significant support level in determining the price direction. Each time the price approaches this trend line, strong buying reactions occur, confirming sustained demand in the market. Structures formed after the upward breakout of this trend line are often noticeable even on longer time frames. Long-term investors test the sustainability of the trend in such reversal setups. If the price continues to stay above this trend line and bounces back upward after each correction from increasingly higher levels, it lays the foundation not only for a short-term, but also a medium to long-term uptrend. The observed beginning of this upward trend in the current market structure is quite encouraging for bullish investors. These structures are considered strong signals of trend change in technical analysis. The fact that the price is now being bought at lower levels, closing above previous lows, and that selling pressure is gradually decreasing indicates a shift in market psychology. Another important factor to pay attention to at this stage is trading volume. An increase in volume alongside higher lows and highs strengthens the sustainability of the uptrend. Volume represents the power and conviction behind a price movement. If the price rises with increasing volume, it usually signals that institutional buyers are stepping in, that there is serious buying interest, and that this interest may be strong enough to push the price even higher. Moreover, if there is a previously well-defined resistance level where this rising structure is forming, and the price is now using that level as support, this is a significant confirmation that the trend has indeed reversed. In technical analysis, the resistance becomes support rule is one of the strongest reversal signals. That is, if a level that previously couldn't be breached is now easily passed and then tested and confirmed as support, it means that the breakout has attracted new buyers. All these positive technical signals may indicate that the uptrend is just beginning. Especially during the transition from a downtrend to an uptrend, investors often fail to fully perceive the shift at first. However, those who take positions during this transition period typically earn significant profits as the price rises later on. Trend reversals are the starting points of large movements, and if these reversal formations are read correctly, they can offer great advantages to investors. The fact that the rising trend line is continuously tested and respected by the price also reveals how strong a demand zone this area is considered by investors. This line represents buy zones not only psychologically but also technically. Seeing a stronger price move after each bounce confirms that the internal dynamics of the trend are solid. That is, there are still many buyers willing to enter the market. Furthermore, this rising structure shows that investor expectations are beginning to shift. Those who used to panic sell during price drops are now starting to buy the dips. This means that the market has passed a psychological threshold, because a trend is shaped not just by chart formations, but also by investor behavior. The presence of an investor base that now sees pullbacks as buying opportunities instead of one that sells during dips and buys during rallies is extremely important for the sustainability of an uptrend. Looking at the current situation, the positive structure and rising trend that the price has been maintaining for some time now are reinforcing upward expectations. Each newly formed higher low and high gives investors more confidence and also increases their appetite to buy.
RSI is one of the most effective and common oscillators used in technical analysis to measure market momentum. It is often used by traders and analysts to assess whether an asset is overbought or oversold, and is often noted for its potential to generate signals in advance of price movements. In the chart we are currently analyzing, the RSI indicator has made a very remarkable and meaningful breakout. Especially when it breaks the pressure along a bearish trend line, it can be a harbinger of an important transformation, both technically and psychologically. While on the surface, this breakout may seem like a mere technical detail, the underlying dynamics are much deeper and more meaningful. A downtrend on the RSI usually indicates that the market is weak and momentum is steadily weakening. In this case, prices will often follow a downward trend. However, an upward break of the fallen trend line on the RSI indicates that buyers are starting to gather strength, selling pressure is weakening, and potentially a new bullish wave in prices could begin. Such structural breakouts, especially on a leading indicator such as the RSI, often occur before price action, saving traders time and offering serious advantages in positioning. Until now, this downtrend in the RSI indicator had acted as a ceiling, preventing upward momentum from developing. However, after the breakout, this ceiling may be replaced by a potential floor. This is because in technical analysis, it's not uncommon for old resistance to become new support. Therefore, after this breakout in the RSI, there's a high probability that this level will be retested in the coming days, followed by a move towards higher levels. In addition, the level at which the RSI makes a breakout and the slope of this breakout also contain very important details. If the breakout occurs at a level close to the RSI's oversold zone, for example in the 30-40 range, this indicates that prices are very close to the bottom, which signals the beginning of a possible reversal. On the other hand, if the RSI breakout occurs in the middle band around 50, this is a strong indication that the balance in the market is slowly shifting in favor of buyers. And if the breakout is close to the upper band, for example the 60-70 range, it may indicate that the market has already switched to a strong bullish momentum and the uptrend is gaining momentum. A breakout of the downtrend on the RSI indicator also indicates that the previous negative discrepancies in the market have come to an end and that positive structures may now come to the forefront. The power of such breakouts increases exponentially, especially if they are combined with positive mismatches. If the RSI is bottoming higher while the price is bottoming lower, this kind of structure creates an opportunity for smart traders to enter the market early. In the current situation, the RSI indicator has crossed the falling trend line to the upside and continues to maintain its momentum after the breakout. This suggests that sellers are slowly fading out of the market and buyers are starting to take control. If the RSI's rise also coincides with higher lows and higher highs starting to form on the price chart, this creates a very strong synergy from a technical point of view. This alignment provides traders with both price and momentum-based confirmation and is often seen at the start of major uptrends. Another important point is the momentum expansion that can occur after an RSI breakout. This expansion can not only lead to higher prices, but also to increased trading volume. This increase in trading volume after RSI breakouts indicates that confidence in the market is rising and new investor inflows have begun. This provides a strong basis for both the price and the RSI to move higher. Such breakouts in the RSI also provide stronger signals when analyzed in combination with other technical indicators. For example, if an upside crossover has formed on the MACD or the price has started to hold above the 200 EMA, the RSI breakout can combine with these structures to trigger a much stronger uptrend. These multiple confirmations are especially valuable for medium and long-term traders, especially when the breakout of momentum indicators like the RSI is combined with classic price action patterns. The signal strength is doubled. For example, if an RSI breakout is seen in combination with addition handle, an inverted shoulder head shoulder, or an ascending triangle pattern, the targets of these patterns tend to materialize faster and stronger technically. RSI should retest the trend.
Yes friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.